Hey, almost looks like we're in some cave somewhere. That's cool. I like the shimmering of the lights and stuff. Neat. Cool stuff, man. Welcome to the closing beat. Happy Tuesday. How's everybody doing out there? Hope all is good. We're just playing around with some things here in the studio, so don't mind us if there's a lot of back and forth. Just having a little fun. You know what I mean? We get this big space here. We got to do some stuff with it. Anyways, we're financial advisors here to talk about the stock market. That's what we're talking about today. The market rally continues. Today was a broad rally, right? Meaning across the board, however you want to look at it, large cap growth stocks, large cap index, large cap value, mid and small factors, all of those. The best performers were in the small cap space. Small cap growth beat everything else in terms of a one-day total return. Just a broad rally there, right? We got some home price data that came out that showed home prices are still up nationally 13% compared to last year. However, we're falling at the fastest pace ever. So, I don't know. It's a tough one. I'm not picking on Dave Ramsey telling you that earlier this year was the best time ever to buy a house. We all get some wrong there, but I'm thankful. I actually want to see, prices come down and take a little bit of a break. I think a lot of you guys do too. So, to give us an opportunity, right? To buy something that you feel is at least a little bit of a discount. What that shows is the Fed is winning. Right? Me and Eric, remember we did a video a couple Fridays ago where he made the case that this is going to be a disaster, and I was making the case that so far, so good. And so far, I think I'm winning, right? So the Fed is winning because, remember, they want the economy to slow down without you losing their job, but they're totally cool if you lose your job. They said that. That's not my words there. So for the moment, home prices coming down. Inflation's at least flatlined. We can't call that a peak yet, but it's close. It's flatlined. What they're doing is working. It's stopping you from spending money. That's the end result, which sounds like we're battling some non-existent or non-visible sort of creature out there. But in reality, we're all battling ourselves. They want you to slow down your spending so that the economy can just kind of breathe a little bit, right? You went too far too fast. So I think it's great. I think the Fed is actually winning there, and it's a good thing. If we go over to the charts page, you can see the S&P. That's going to be 3 days in a row. 3 days straight up. We're now 7% off of the October. Well, we're up 7% for the month. You want to look at just October. It's almost over. But we're up 7% for the month. Only 19% more to go year to date before we, would turn positive. So I don't know that happens, but the market's still down about 19. S&P is down about 19% year to date there. One of the things that could help fuel or continue to fuel this rally is the Commitment of Traders report. Not something I normally talk about because it's a futures-based analysis kind of thing. But if we take a look over here, here's the Commitment of Traders report that shows the net positioning of futures traders, in this case in the S&P. And basically it measures open interest, and there's a lot of little variables that go into it, but we're generally measuring the open interest, in other words, the potential positioning of people in the market. This doesn't mean that people believe the market is headed lower, because right now the net position is 9 points short, meaning more people are short than are long or wanting to be short. So that doesn't mean that people are betting against the market. This could be hedging. That's what I always had a problem with the Commitment of Traders report. It could be people hedging their positions. It could be speculators. It could be existing positions. But at the moment, most are positioning for a move lower in the market, and we're just off of lows there. If you want to look, this is basically 10-year lows, right? We just came off of 10-year lows there. Largest net short position still in the last 10 years, if you account for this area, not just this blip right in here. And if you're curious, the only index that futures traders are net long, it's not the NASDAQ, it's not the Dow, it's the S&P 400, all right? So getting into that S&P 400, little not as popular index that's out there. That's the only one. Now, if we go on over to the charts here, You can see where the S&P is at. If you want to look at the Dow, where'd it go? There we go. The Dow recovering the fastest so far. It's only down 12% year to date. It's up 7%, the same over the last 30 days. So we got a nice little rally off of lows here. However, there's still this big downtrend, and I illustrated it on the S&P by using this big blue line, just so you could see. It happens to coincide with the 200-day moving average. So in the midterm, right, in the short term, we're here. We've hit a short-term temporary resistance area. It was an area we had problems before, lots of volume. It was a sticking point for the market. But if you want to look in the midterm, the idea is that we could hopefully get back up to the 200-day moving average or the top of this downtrend. This will not happen in all one fell swoop. I believe that. It will be a rally, a trend kind of a move there, just like you saw over here where you have your fits and starts along the way. That's totally expected there. But if we look at the Dow, just wanted to point out that's your best performer here so far. If you look at the NASDAQ, obviously it's doing its thing, not going down without a fight. It's averaging 1% a day over the last 5 days, just about. So like I said, it's just about 5% gains in 5 days. That's going to change tomorrow, by the way, at least to start the day, thanks to some of the earnings that have come out. We'll talk about that in just a moment. Lights still working? We've plugged in too many things, man. Understandably, the NASDAQ is down the most year to date, still down 29%. So you can't give it any grief for that, right? Russell 2000, although it was the best performer here today, is the worst performer overall, refusing to come off of the lows. Remember, these are small cap stocks. When these guys catch a bid, watch out, right? Because look at what's happening with the dollar. Now, little help today, but as long as the dollar stays strong, who benefits the most from that relative to the others? Small cap stocks, those that derive the majority or all of their income or sales from here in the U.S. A strong dollar actually helps small caps. It hurts the large caps out there. So you kind of can understand why people were willing to be in some of the large cap names today. We're starting to get a break in the dollar here. It's not giving up a top as easily as you would hope, right? It's not a clean, consistent pullback. It's rather interesting that it refuses to pull back. And we are, as we talked about, seeing that play into the earnings reports for a lot of companies. I'll talk about that in just a moment there. Energy. I don't know what you want to say, man. This is a tough one to chase right here. It is by far the best performing index sector so far this year. It's just about up 65% year to date, which you got to go back to around my birthday over here when it was up this much, right in that area anyways, and it lost half of its gains rather quickly. That's a bruise that's in recent memory there, so it's hard, I think, to chase. In this case, we're going up a little bit slower, so that's a little bit of good news, but think about this. The only other sector, the only sector that's positive, by the way, is energy, right? Consumer staples needs to gain about 70% more to catch up to energy, and consumer staples is in second place. This is the second best performing sector of the year. It's down almost 7% on the year. It's got to rally 70% and have energy stay in place just to catch up. Gives you an idea, number one, of how strong energy is, but number two, how important it is to have energy in your portfolio. If you were one of those that said, I don't want to support energy, fine, that's okay. You're able, it's America, you can make that decision. But if you didn't, you are down more than the market. There's no two ways about that. You are down and losing more than the stock market this year. So just don't beat yourself up, right? If you believe in not having energy and all of that, you just have to realize this is a tough year for you. You're going to pay for it this year, and hopefully it works out in future years. But oh boy, that's a tough one there. It's hard pill to swallow if we're going to keep using analogies. I'm from Texas, so I get to do that. Tech sector. All right, here we go. I'll say tech sector and communication services. These are averaging more than 1% a day over the last 5 days. Why? Why would that be? If rates are headed higher, then how is it, and that affects these two sectors kind of the most lately, I mean, for the sake of them largely borrowing a lot of money out there. Why is that? Why would they head higher? Why wouldn't they lag behind everything? Even today, they were about middle of the pack. Consumer communication services was the second best performing sector today. Tech about middle of the pack. So why would they even participate, right? Number one, we had rates fall a little bit. I'll go over here and just show you. You look at bonds, there we go. First real dip in rates that we've seen. In other words, prices moved higher while yields moved lower there. They work in inverse there. The bond market ranks in the top 10 of all of the most volatile years on record, right? Rapidly rising in the top 10 there. And so when you look at these tech stocks, communication services, it seems as though people are putting money over there. Are they just being reckless? What's going on? The belief is being priced in. You know how I say that every once in a while? I say, this is already priced in, and you go, well, Dustin, how do you know that's who knows that? When you look at those stocks, they're going higher with the market, which is greatly helping to lift the market. But it's because of the belief that the pace of rate hikes will slow. Right? It's okay if rates stay high for tech stocks. It's not okay if they rapidly rise and continue their rapid rise. It makes it very difficult for them to forecast their borrowing, right? And it makes it difficult for them to sell bonds and things like corporate bonds. So people must believe that the pace of rate hikes is going to slow. And according to that leak that came out on Friday, which started this whole thing, that is the general consensus about what the Fed is going to do. So rather interesting there if you catch these little things going on in the market. I've got one in just a minute. Let's see if you catch this one as well. Where are we going to go here? By the way, let me pop over here. Our Wine and Wealth class, there's actually 2 of them from last week. I want to show you, just for clients here, it's not like marketing or anything, just want to make sure you guys know this is in there. You go into your portal. This is our own portal that we built and everything. You're going to come down here and you're going to see the anatomy of a market bottom. We did 2 of them because it was okay. This one was fine, but I wanted to make sure you got the point. So we went through all the data of how to see a market bottom, how to expect, or what do we expect in terms of bounces and everything. Really good data-driven class there. So if you go into your portal, click on classes and research, that'll take you over to that. This week, Eric is going to be going over all the changes, all right, between your IRAs. I covered a little bit already in our email, but your IRAs, the tax brackets, what's the game plan there, right? Just because the numbers changed, we don't just accept them and move on. Remember, when you think about your dollars, you think strategy. Okay, what's the strategy, man? What do we do? What's cool with that? So he's going to cover that here this week. All right, other than that, when you look around the stock market, I do want to point out 2 other things right now. You got Microsoft in the news. So earnings for Microsoft, not too bad. Cloud revenues down. I'm just digging into this for the first time here. You've got the cloud, actually, just not as good as expected. They're still killing it over there in that cloud space, but that's for the moment causing Microsoft to be down about $4, $5, give or take a little bit there. Who's counting? And then you got Alphabet. Remember, when the MAGA stocks, we talked about this yesterday, MAGA, Microsoft, Amazon, Google, we still say, and Apple, when they report all in the same week, typically we see weakness. That is already showing that's the case, right? You've got Alphabet down, breaking the $100 mark there. They're working on getting leaner. There's nothing easy about this, right? The company says, look, we know the economy is going to slow down. The Fed's doing the right thing, and they're all for the Fed and all that. But when you get leaner, you got to make some cutbacks. When you make cutbacks, you're limiting your exposure to more revenue. All right, so there's a give and take there, and that's probably understandable that Alphabet's down a little bit here today. We'll see how tomorrow plays out. If we go to stocks in the news here for the day, we'll see, right? Twitter, the deal's got to close Friday, right? So the assumption is we haven't heard a whole lot in terms of there being a change in mindset there. So this deal with Musk and Twitter is expected to still close on Friday, unless I have missed any near-term news. And I believe Elon Musk has said we're making this happen. This is going to close by Friday for $54.20 as the stock price working its way up there. So cool. Put all that drama behind us, huh? UPS. So UPS beats on earnings. That's 9 quarters in a row, by the way, that they've beat on earnings. 5% better than expected there. U.S. packages. Revenue from delivering U.S. packages beat expectations. I always like to look at that and compare it to international revenue from delivering packages. They missed a little bit there. So that's part of the weakness there. The full year guidance was not raised. It was what's called reiterated, which is not what we were hoping for there. UPS, naturally, a barometer for the consumer. It's a barometer for the U.S. markets because we're a service-based economy. We buy, stuff that we don't really make. We just kind of trade stuff around. So that's why people say that we are less of a manufacturing economy. Agree or disagree? That's just where it stands, and that's what we have to work with. General Electric earnings missed by 25% of analyst expectations there. That was a pretty big miss there. Lowered their guidance, and the reason that they missed is because their green energy division will lose $2 billion this year. It ain't cheap going green, man. So as they make that transition, they realize the losses there, and that's what you take the little hit for. CocaCola, I was very interested in this one here today. Almost as healthy of earnings report as Pepsi. Pepsi does win there just a little bit. 16% organic growth there. One negative was their total gross margins. They were down to 59.2% there. Forex was what affected their bottom line. That affected their total bottom line to the tune of 7%. It was 6% last quarter, so it increased a little bit there. People didn't like that. That's how you started the day, a little bit negative on Coke. Now, they guided next year to say that they expect a 7 to 8% hit on their total bottom line due to the dollar. Did you catch that? Do you see what's happening there? So they already expect and are factoring in their earnings projections that the dollar is going to affect them by 7 to 8%. So if we get to the first quarter of next year and the dollar has fallen and stabilized, what do you think will happen to those projections? When you look at Coca-Cola, at some point before that, they're going to say that they now expect their Forex headwinds, I use that word because everybody else does, Forex headwinds to be 4 or 5%, right? Did you catch that? So in reality, you're watching the dollar for your assumption on the change of their hit that they're going to take on the dollar. And if the dollar moves lower, we know that that's going to benefit Coke. We know that the stock price will benefit from that. So they gave you the heads up there. Who noticed that? Oh, come on now. We got a new keyboard or something here. All right. FICO in the news. These are the credit score guys here. Very cool. I'll just point this out here real quick. The Federal Housing Finance Agency, FHFA, yesterday, they said that lenders will now need to provide a FICO 10, which is way advanced here. They're 3, 4, and 5 at the moment. So FICO 10 credit score, as well as a Vantage Score 4.0 to Fannie Mae and Freddie Mac if people want to get a mortgage in terms of qualifying the mortgages there. So obviously that's positive for FICO, right? That's good news for them because it means that's guaranteed business. You have to have a FICO credit score in order to get a mortgage. That remains the same there. Additionally, I just want to throw this in there. You now only need 2 credit reports to get a mortgage, or you will. They're going to phase this in, right? So you only need 2 credit reports, whereas usually you need 3. That hurts TransUnion, Equifax, Experian, right? Because we're not pulling data from them. Therefore, we're not giving them money as much to pull your credit reports there. So, rather interesting there. And remember the Vantage score, if you're just to go down the personal finance route, Vantage scores include more than just your usual traditional credit. Your rent payments can be included. Your energy bills can be included. So you have a chance of really helping yourself out there. Oh boy. There we go. I made that too big. And so I just want to point that out. Very cool. If you have any questions, I'd be happy to answer your questions. There's kind of a lot going on here as we move through the busy week of earnings there. And that continues, by the way. Don't go anywhere, right? Don't go anywhere. You hate the term headwinds. Yeah, that's your drinking word for the week, man. You hear the word headwinds, you're going to be in the hospital, man. I like it. If they start using updraft and everyone's, I don't know what you're talking about. What are we talking about, sports or something like that? I knew I'd get somebody with the mega stocks. I didn't come up with that. That's just what they call them in earnings week. It's been 9 9 quarters that they've actually used that term. This is the 9th quarter that those stocks move together, and it's because of Kramer. You guys, that it's he. I don't know that he came up with it, but he came up with the FANG thing, and so everybody wants a piece of that, and so they come up with MAGA probably to get some attention and stuff. But who knows, man? Who knows? Credit score importance, dead wrong. Well, it'll be easier now, at least, to establish a credit score without having a credit card, right? And that's been in the works for a long time, using that Vantage score there. I think it's probably helpful. Right? Not everybody wants to keep a credit card and stuff. I get that. You are very welcome, Truth. Thanks for hanging out with us here. Yeah. Thoughts on General Motors? J-Block, you got to General Motors? They were the other general to report today. So General Motors, where'd we go on that one? Did I even jot anything down? I don't think I did. I had so many to look through here today. The beat on earnings, guidance was the same. That was probably the weak spot for them. People were kind of hoping that would be an increase. I think they got the boost from the Bolt. So they're going to increase production of the Bolt, and that's a profitable car, right? So a little more competition out there for the electric car market there. Does anybody really like the Bolt, though? You know what I mean? Ugh. Yeah. You haven't heard the chat about real estate stocks lately. Have you not wanted to talk about those? That was actually the best performing sector here today. Real estate, utilities struggled a little bit, still 2% gain. Rates coming down a little bit, for goodness sake. What a brutal downtrend in rates. So there's not much to say until there's a little relief there, huh? Yeah. You have, what are you doing there with these Qs and Qs? Read the Qs is a trust who invests dividend gains. However, QCOM will. I said QCOM. So you have a traditional, so you've got a traditional ETF here for QM. Is that kind of new? I was thinking this was a leveraged one, right? Is this not leveraged? No, I don't think it is. So what's the deal with these guys? You want to know what's going on with them? What are they doing there? Invesco. So is this more of the intraday? You can go up to 90%. I don't. Oh, this one has a little bit more rebalancing in there. That's what it is. So it's not a direct index tracker. They're attempting to prove rebalancing is something a little bit better. That's what I get out of it anyways. The holdings are basically the same percentage-wise. Not entirely sure. It's not leveraged, though. Yeah. That's usually what I look for. When people usually mention that these oddball ticker symbols, they're usually leveraged products, but that one's not. I've never seen that, actually. It looks to be, at first glance there, that's their focus, is a little bit more rebalancing to try and improve the returns with the dividend, of course. And because of that, your dividend is treated as ordinary income, by the way. So there's something more to it that I'm not catching here at first glance. I have to look at that for you. They may have, what are they doing with the other 10%? There's probably something going on with the other 10% that causes that to be registered in a way where we need the ordinary income, or we get hit by ordinary income. So I'm not sure. That's at least initial thoughts there. Jason, can you repeat that again? How do people build credit without a credit card? Never heard of that before. Well, you just do what you do. I'm saying the Vantage score, look up the Vantage score and how it's calculated. It's much different than the FICO score. So now the thought is more people should be able to use other means for proving credit worthiness to buy a house if Fannie Mae and Freddie Mac are requiring to have both the FICO score and the Vantage score. Yeah. Yep. Lisa says, can you look and do things in my 403B? Sure can. We sure can. You want Roku to bounce there? Yeah, somebody's gonna. I agree. Yeah, I think it's got to be. I think it's got to be a buyout, but they keep pushing back on all that. So it have to be maybe one of those hostile takeovers there. Where's Harry at? Is he not in there? Harry taking a break. Why hasn't Carnival Cruise recovered yet? Aren't people back to vacation again, or we need inflation to come back down before people start taking more cruises? They are busy. I will give you that. Carnival Cruise took on a lot of debt, so as interest rates rise, that debt becomes more expensive. That's the focus for Carnival Cruise now. That they were forced to take on debt, got great rates on that, but now it's more expensive. Yep. CCL is Kmart, RCL is Walmart. Nah, come on. Royal Caribbean's like a Target, right? You know what I mean? Quality-wise. All right, we're getting off track here. That's all I got for you here today. I appreciate you hanging out with us and joining us for the conversation. We'll be back tomorrow to do it all over again for Hump Day, historically, or this year anyways, being the best performing day of the week. I don't know. It's been a pretty good week so far. We'll see what happens. You guys enjoy the rest of your day, and yeah, we'll see you tomorrow.